Okay, hello traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, June 2nd. Michael Boutros here with you on the wire. Hey man, great to see you. Hope all is well with you as well. Aurelian, DJ, Jay, Michael, Pete, Rizwan, Ted, great to see you in the room. Hey Ashwin, great to see you as well. So, lots to talk about. At the beginning of the month, or I guess heading to yesterday, we were talking about DXY coming to a support zone. It broke below that 618, but we're seeing some really provocative price action. Again, keep in mind, guys, it's still early in the month. We're just setting up the monthly, weekly opening ranges. Obviously, a lot of headline event risk, but the markets, from a risk standpoint, are still well poised. Okay. Coming to some level, so we'll look at that as well. So first off, DXY as usual, Euro will hit Kiwi and dollar CAD, Sterling, dollar Swiss. Just a quick note on Aussie Kiwi, it did make a higher high, but it's still holding that slope. So Eman, I think you were talking about that. We'll take a look at that. SPX levels, gold, dollar yen, and we'll wrap it up with good old Aussie dollar. Any other questions or trade setups? As always, feel free to throw them on the message board at any time. So here's what DXY looked like into the start of the month, okay? The level in focus was this 618 retracement of the near-term advances. That's just off the low for this year's range, gives you 97.87. The broader 38.2 from the advance off the 2018 low gives you 97.35. We just missed 97.35 on this last dip, and here's the retraction. Now, momentum on the weekly standpoint, nothing to really write home about. A couple of things just to note is the slopes that we've been working with. I'm sorry, this is in log scale, that's why it looks a little off. The slopes that we've been working with, so that parallel, basic parallel, this is all still derived off the same slope, guys, off the same dominant slope. So 1 touch, 2 touch, 3 touch, where they discount that as a breakthrough, that converges here as well. Daily chart looks like this. Now, we are working on our 6th consecutive daily decline if today closes at these levels. Not a reason per se to get bullish, or I guess to quell the short side, but there's a couple of different things to look at. Again, aside from those slopes that we looked at in the weekly chart, here's your daily chart. This is a basic pitchfork we've been following from 2017, 2018. Median lines right here, right below this level. You also have that 97.71 level, which is the swing high from 2018. Nice pivot zone. Watch the reaction here today. Okay, watch the reaction here today. Here's what it looks like on the intraday. Well, before I do, I noted about 5 days down or 6 days down. What does that mean? Well, if we take a quick look, okay, at when's the last time we saw 6 days down in price on DXY and what happened? The last couple of examples are telling that we should look for a little bit of a rebound. Okay, if we look at the previous example of 6 days down, was right here. We had it back into the close of April. That charged the initial May rally, which inevitably broke down. All right, what about before that? Last time we saw 6 up was right here. That called the December decline before, obviously, the first quarter ripper there. So you can see that, on average, we should be expecting, or the threat remains, not too many 6 day down beyond that, for some sort of corrective bounce, some sort of exhaustion low, some sort of rebound in price. Here's what it looks like on the intraday chart. So again, that key level of support that we talked about, 97.87 to 97.71. Okay, here's the open of the week. We dropped right into it, sat there all day yesterday, buckled below it, an overnight trade. This is the test. Okay, if we come back and we fail here in early US trade, you're looking for 97.71. If we don't, and this makes it back above, well, you never actually got a daily close below. Okay, and I think you'd be at risk for a larger recovery towards 98.27 or the upper parallel. So just a word of caution here. We're early in the week, like I said, early in the month, a good time to kind of play it a little bit more cautionary, more reserved. But as it stands right now, I'm on the lookout for possible near-term dollar exhaustion on the downside here. Questions on DXY. It's a big week for the US still. Don't forget, we have non-farm payrolls on tap heading into the close of the week. We also get CAD employment at the same time. It's been a big week for event risk anyway. BOC's on tap tomorrow. You got the ECB on tap the day after. Lots of stuff going on. Okay, so just a quick look here at DXY. Any questions on this before we move off? All right, that's number one. Here is what Euro looks like. And here's what it looked like last night. So the focus here is a resistance range just higher, and we've been talking about it literally for months and months and months. It's 111.86 into 111.67. Huge zone, Fibonacci confluence zone of 618's longer term or medium term, excuse me, slope resistance. You got the median line right in there as well. And to start off the week, that's kind of what we're trading just below. The same risk remains there. Okay, we probed into it, and now we've gotten a tag of 1186. This is the tell. Let me go backwards. I'm going to take you back to the weekly chart real quick. Here's Euro on the weekly. Okay, this was a level that we've marked out clearly since the March rally and rip, or rip and decline, right? 618 of the yearly range. Again, longer term, 618 off the 2017 advance. Opening range highs for this year, right? Here's the January open. Nice zone of resistance. And as I've always said, this slope that we've been following here, which is just a parallel again of the dominant slope, which broke in March, if this break is legit, this is the level that needs to be cleared. So immediately heading into the US session today, Euro long sides at risk below 111.86. If we clear that, I want to see acceleration. I want to see what happened here. Okay. I don't want to see a muddle kind of, and if we don't close above, obviously that's, another exhaustion indicator. But certainly from a weekly standpoint, big level for Euro, right? Big level for Euro. Here's what it looks like on the daily. Again, that confluence region, 1186 into 1166, 1167. Okay. And this looks like it might be on its way to complete 6 days, 7 days up actually. Still at 6. Here's the last time we did that. Here was another 6-day advance that saw just a couple of days pause before resumption. And then you're going back years. So another highlight, okay, another suggestion of why Euro might be exhaustion on the near term for the long side. Same thing with the DXY on the downside. Now, at the same time, if we do breach the big target on the upside, 2 equal legs off the yearly low gives you 112.39. So clear cut 50, 60 pip rally on the upside if we do get that breach. Not only is that the December swing highs from last year, but it's also, like I said, the 100% extension off the low. So levels are clear. Let's see if we can't get some Momo on this. Here's what it looks like on the intraday again. And here's what it looks like, what it looked like earlier in the week. All right, so watch that resistance zone right now. We're testing it as we speak. US Open is going to be the tell here. If we pop through, look for 1239, look for 1312, excuse me. But it's big here. It's big here. Don't get faked out. If you're holding long, it's a good area to start taking a little off the table. If not, taking your stop to break even or better. All right, questions on Euro. ECB is on tap on Wednesday or Thursday, excuse me. So we'll have our webinar here right as that goes on, and we'll get you ready for NFPs on Friday as well. Okay, another one from last night was Kiwi. I just wanted to highlight this because the breakouts seem to be accelerating. We are getting further acceleration on this move. The 618 retracement at 62.65 is really what we've been focused on as far as Kiwi is concerned. Here's what it looks like. Let me take a step back here. Here's the daily chart. Let me go even further. Here's Kiwi on the weekly. Okay, levels of interest that we've been looking at on the top side advance. Remember, we were talking about the concern for some exhaustion on this rally into 62. We got 1 day down, and then it's been recovery ever since. So this is the low week close here at 63.13. Just higher is that slope resistance. Okay, I don't want to put too much emphasis on this pitchfork. I realize that we've already kind of gone through levels a couple of times, but something to be weary of. Here is what it looks like on the daily chart. It's that same slope, right? You got the 2016 low, 63.47, and then the November low, which we just talked about, 63.22. That's right here. So maybe a little higher in Kiwi. Note that momentum is heading right into the 70 threshold. We get a breach here, again, you should acceleration. We've already had a pretty radical rally alone in just the last couple of weeks. We have a 7% move. So guys, on all these trades, well, I still like the Kiwi long side and I still like, you know, even Euro, the long side, near term, those advances getting kind of stretched. They're getting kind of stretched. Here's what it looks like on the intraday. And here's what it looked like last night. So the break above 62.64, as I said, look for support back there now, exactly where we were, and that's exactly what happened, okay? We broke through, we checked support right there, and here's the next level at 63.22. So watch this zone into the open. Again, just higher, 63.47 is that 2016 swing low. That's your next upside level. Into this zone, I'd be very cautious on holding any further Kiwi longs. Now, as far as trying to fade it for a pullback, even on a near-term front, that may be a decent play, but we don't have any evidence or technical factors to support that theory just yet. Okay, so sit tight here on Kiwi. I want to see an extension high. I want to see an exhaustion. I want to see something happen here as we test fresh multi-month highs. Questions on Kiwi? Gary says, hi, Mike, will you be covering dollar sterling? I mean, I think you mean sterling dollar. Yeah, that's on the list. Absolutely, Gary. And he says, I've still got the grumps with the abomination. I think we have permanent grumps with the abomination, Gary. I don't think those wear off very often. But yeah, we'll hit both of those. Let me just go in order real quick. So that was Kiwi, number 3. Here's number 4, which is dollar CAD. And heading into Friday, obviously, this is going to be an important one. I put out a piece yesterday on daily FX for this one, really focused on this 36 handle, okay? And this is a level, again, that we've talked about for quite some time. Here's dollar CAD on the weekly charts. It's defined by the 618 retracement of this year's range and the high week close from that 2017 spike. You saw that that caught the highs back on the 2018 advance there. So, man, we plummeted right through it. We plummeted right through it. So now we're testing the high week close from May of last year. That's 36.15. Remember, everything on this chart, guys, only matters on the weekly close. So I bring this to your attention now to highlight the levels, but really it's the weekly close below or above that 35.15 that's going to validate a break of that level, okay? To fill the gap, by the way, you would need a move just to highlight the actual level. We'd need to move down into 34.20s. Okay, here's dollar CAD on the daily chart. Wider pitchfork we've been following from the lows here. This is the 2016, 2017 lows. You can see that I think this is the 618, excuse me, parallel support. Nice little inflections on both sides there. We're testing that as well. May 2019 high day close, like I said, 35.15. We're testing that as well. Momentum grounded at 30. Pay attention. The breakdown level, okay, the level that would, in my mind, give us a clear-cut break of upslope support here would be 34.30s. Okay, it's a 2017 objective open. It was the March open. We gapped above it. Again, to fill that gap, we would need that drop just lower, 34.13s or something. But you get the picture, right? So you're coming to some big areas here. 36.47 resistance now. If we close back above that, I would expect a much larger recovery, specifically because that's also downslope support. Remember, a break of downslope support should oftentimes be the sharpest part of the drop. So we're bearish dollar CAD. We're coming into some near-term targets on the downside that could offer a little bit of a rebound. Here's what it looks like on the intraday. Even the slope off the highs that we've been following, okay, on this pitchfork. A little messy there, but nice on there. Break of the median line saw acceleration. Here's the 25% line. Rallies should be governed by 36. I want to see failure ahead of the median line, ideally. Whoops. And again, next downside target's going to be that 2017 open at 34.35. You know, good question. Yesterday I told you bearish in about 39.45 as we were opening the week. Last night I dropped bearish inval to 38.55 as we were breaking the median line. At this point, look, I don't want to clutter the chart. Ideally, for my own trading, when we make a stretch like this, the bearish invalidation level typically goes right up to the weekly open. Okay, so like 37.55. That's playing it real close to the chest. If you open it up a little one, it'll be a little bit more objective. A breach above the weekly opening range high would be an objective upside bias. So, depending on where your positioning is, guys, like for me at this point, I would like to stay bearish invalidation 37.75, just a bit higher, 38, would take you through the opening range highs for the week. Don't think we get up there, but that's the bearish inval levels to answer your question. Kelly says, I'm short from 141.25, looking for 32.91. So you're in a much longer term position there. What do you got at 32.91? What do you have at 32.91? Let me ask you that. So with a position like that, Kelly, I mean, you're so far in the money already. You have the luxury of sitting it in, even if it recoils against you. Anyone who's looking near term, watch for a reaction around the median line if we get up there. If that fails and holds, I think we're in for that stretch toward 34.35 and beyond. Kelly says, exactly. Well played. Beautiful entry. Beautiful entry. Okay, it's going to be a big week for Looney heading into the close. Again, got trade balance figures coming on the 4th, not really going to be a major market mover. It's going to be BOC tomorrow, and heading into Friday, the employment numbers out of Canada expect to be pretty nasty too. Unemployment there is expected to pop up to 15%. Unemployment here is expected to jump into 19.7. Again, you'll hear the arguments all over the place. I don't want to get into the fundamental quote unquote backdrop, but you'll hear arguments all over the financial news publications, guys, about, well, unemployment, while the number seems dire, it's going to be temporary. Once the markets come back online, the stores reopen. That's true, right? It might be short-lived, but I think the detriment or the extent of it won't be known for a while. Some of these stores won't be coming back, will not have been able to sit out, the last 3 months of the shutdown. To throw in another, just B asterisk, this whole thing with the riots, a lot of these stores that have been waiting to come back are just set to open. Now they're coming back and, their stores are completely destroyed. Now, this is local, right? It's not something you can sort of spread as a staple across the whole economy is going to get hit with it. But with every major city seeing these riots and the extent of the damage and, the behavioral change that might inflict on consumer spending, who knows, right? But at the end of the day, the employment figures on Friday are going to be closely watched by the markets, and dollar CAD is going to be right there on our radar. All right, number 5, sterling. Gary, here it comes. British pound with a beautiful breakout. Hey, listen, yesterday, I'm not going to lie, I thought 25 was going to hold, 25.20 was going to hold. I wasn't in a short, but there was no long for me anymore. I kind of thought this was going to be a pretty radical stretch. Don't forget, sterling's well known for the throwover, right? The king of the throwover, in fact. The false break of resistance and pullback, the false break of support, then recovery. So I don't want to get faked out on this. For me, 125, 125.22 is a big area. It's a 786 of the decline off the highs that we made back in April. It's also the 161 extension of the ascent off the low. You saw it the last time we hit the 100 was another barrier, pullback, break, and acceleration. So what do you do here? right? You're looking at long-term downslope resistance. You're looking at last month's open just higher at 25.93. There's no new positioning to do here on the long side, guys. If you're holding longs, those are your top side next levels to look for. 25.93 and 26.22 is the high day close from April. If you're looking for fresh exposure, you're trying to fade this, I would use caution. I would not recommend it just yet, just because of where we are trading. So another one, a couple of these trades, guys, a lot of these dollar majors, if you're not already in them, we got to sit it tight. And it's early in the month, so that's okay. The market will always provide more opportunities. I think we just need to be cautious here with the environment we're in. So sterling for me has kind of been a no play. The break above 124.27 was great. The next big level was 25. That just broke. If that offers support into the US Open, you're still looking for that extension towards 26. No sterling data of reckoning or of note this week. Okay, so we're kind of going to be really more based on broader market sentiment and just price action here. That's number 5. Number 6, Swissy. Here is what dollar Swiss looks like. We hit dollar CAD. Sterling we hit. So the sterling levels are unchanged. We broke through this, and we're sitting at this support right now, right? Look for these two topside levels. Here's what Swissy look like. So remember this thing we were talking about for weeks. I haven't given you guys a weekly or daily chart in a while just because there's not much to look at. Here it is. But you saw this consolidation, right? Last week it looked like it broke. If that consolidation did break, well, then recoveries should fail ahead of the yearly open. Okay, look at that slope. I'm not really a big fan of this, but the near-term picture looked clear on this break, and here's what it looks like now. Okay, consolidation did break lower. We opened the week, we dribbled lower into slope support, and then turned right ahead of that key support zone, which we were looking at, 95.55, 95.65. It's 10 pip range. Okay, we register low just ahead of it. 95.72 was the low. So look, if this formation's in play, I want to see failure ahead of Friday's high, ahead of this pitchfork resistance slope. Ultimately, you would need to see strength beyond the yearly open, in my opinion, to get this thing bullish again. So even if we rally into here, I'm looking for exhaustion. It might be too clean to look there. So if we punch or higher, or we just try to push that pivot one more time, and we fail, don't stress the 618 because we've made a new low. Let me get rid of that. Just watch that yearly open. Punch through the yearly open, in my opinion, would put this thing back on the constructive path, but that's not what I want. Ideal scenario is that you fail at one of these 2 points. Now, as it stands right now, you have to note that we are poised to make an outside day reversal off the lows. I know we haven't even opened up the US trade session, but if markets were to close at these levels, that's what you're pumping here. Outside reversal off fresh lows typically is a near-term constructive development. So caution here on Swissy. If anything, I'd like to fade something towards 96.70 if we get it. Key support still 95.55, 95.65. Any questions on Swissy? All right, quick segue here into Aussie Kiwi for you, Eman. We were looking at this. I just wanted to update because we talked about it yesterday in the webinar briefly. This is really the only chart that you kind of need to focus on here. Here's what Aussie Kiwi looked like last week. So that 618, I've removed it since then, but it was right around here, right? We had this downslope. We fell into a little bit of a consolidation. Man, that didn't hold very long, okay? We did get a decent downside break, okay, last week. Remember, we were playing the pullback off of key resistance. I'll remind you again. Whoop. Aussie Kiwi on the weekly charts look like this, right? We played this pullback. It only lasted for about a week and a half. Here's the breakthrough. Here's the dominant slope from the 2017 highs. Now it's only a 2-point touch. I don't want to go crazy with it, but it's right here. Just a bit higher from where we are now. And again, highlighting the weekly chart, do note that we haven't cleared 108.25 on a weekly close basis yet. That's last week's high week close, just a little bit higher. and then the swing lows from last September of 2017. Huge pivot in price. So Aussie Kiwi. Again, here's the daily chart. Nice pullback from key resistance, that big zone. Here's the reversal. And what is that? What is that? Well, if we close above 108.33 today, I think you're looking for 109. But it's all about this resistance zone today. Note that daily RSI is about to mark its fourth divergence reference point. 1, 2, 3, 4, series of lower highs, series of higher highs in price. You're at extremes, you're at resistance. Look for a reaction here. It doesn't necessarily need to be bearish. I'm not saying that it's going to necessarily reverse, but we should see inflection. So if it pops through this, you should get an accelerated rally. I personally would more be inclined to think to look to play the exhaustion trade here. That said, Aussie and Kiwi are both kind of breaking out essentially. You're trying to gauge which one's the bigger winner. So Eman, does that help? I don't really have a strong conviction. I want to see how today resolves. Above 108.33, the 2019 high day close, I think you keep going. But it's got to close the day above that. If you look at the intraday price action already, we've already made a pretty big wick in just the last 4 hours. We went from 108.77 down to 108.37, like a 50 pip move. So it's tricky here. It's tricky here. Pistol to my head, I'd be more inclined to look for the exhaustion trade, but that might be me just being stubborn. So, Eman, I think we need more clarity on this. It's constructive as it stands right now. I mean, even if you get a pullback in price, the momentum is so, it's on the favor of the bulls. But with that in mind, that's when usually you get those mean reversals and those mean failure spikes and the like. So use some caution here. Yes, thank you. I will keep an eye, says Eman. More than welcome. And we'll continue to track it. I mean, maybe this gives a little bit more clarity deeper in the week, but to start off the month, yeah, I think the long side looks a little tired here. SPX number 8. Here's SPOO's levels. Big, big, big zone. We've been talking about this zone for a while. If you go back to the SPX updates, guys, on SB, we've been nailing this 3069 zone for quite some time. Here's what it looked like back on the 28th of May. We were talking about this rally really testing sort of a nice convergence area. 3069 is going to be the swing lows they made back here in November of last year. And it's going to be the median line for that slope that we've been tracking just off the highs from 2018 and this year. So we're there, okay? He had channel resistance there early in the week. We've kind of moved off that because of the time decay, but you're still at resistance in SPX. Now, on a topside breach at this point, you could see a scenario where you tag this parallel or even go for a 786 then fail, but you have to be cautious because if we break out through the highs that we made back then that February bounce, I do think you get really open resistance real quick. And it's hard to see, a lot of people are justifying this rally based on the economic outlook, all the money and tons of stimulus that's been dumped into the markets ever since the pandemic. But these riots and the civil unrest brings a new dimension to things, guys. I don't think the markets have really they've kind of side skirted that for the last couple of days, I guess, for the week that's passed since Memorial Day. But use caution here. That's all I got to say. Use caution here. On the intraday, here's what it looks like for SPX. So even within the confines of this pitchfork that we've been following, just off the lows, right? Where you still have more room before you even tag the parallel. So you could see some further advances here today. But if you're not already long, it's like the same trade we've been looking at a lot of dollar crosses, guys. If you're not already long or not already in the trade, this is where the exhaustion is vulnerable or where we're vulnerable to exhaustion. So you want to be on the lookout. If that pullback fails, it gives us a better entry to get in the long side. But as it stands right now, I'm looking for a reaction, maybe into a stab at 31 intraday, maybe into a stab at that parallel, but certainly coming into some upslope resistance here. Any questions on SPX? Okay, gold, number 9. Here's what gold looks like. It's been messy. I'll grant you that. We buckled back above 1733, which was our big level that we were looking for the failure below. So that kind of changed things yesterday, and we're just sitting here hovering. Look, for gold, the longer term picture is still all I'm looking at. I think you're going to see a lot more noise. I think you're going to see a lot more sideways action. I think you're going to see a lot more pump fakes to the upside. But at the end of the day, look at this chart, okay? You could make the argument, yeah, that this protests and all this civil unrest combined with, Corona could be very good stimulus for the harbor trade or the safety haven trade, which would be beneficial of gold. I get that. But at the end of the day, we're still at uptrend resistance. Look at this on a closed basis. Don't take my word for it, right? So it is what it is, guys. You might see some more sideways action. I'm still treating gold near term sort of rangy, I suppose. But until we clear that slope, you want to use caution. We've tested and faked out here too many times over the last couple of weeks. Not to mention the divergence that we're getting on the weekly chart still remains with the higher highs in price and the lower highs in the oscillator. Here's gold on the daily chart. I'm going to drop our fresh monthly markers today, guys. I usually leave a couple of days open so we get some clarity here. But here's your June open right now. You're opening right above at that support level. This is sort of what you're looking for. If we pump fake again through those swing highs from April, we haven't closed there. And in fact, that is the close high at this point. You'd look for the resumptive trade. 1795, 1820, no problem. Until we do, though, I'm just not buying it. Here's what it looks like on the intraday. And this is getting kind of messy, okay? This pitchfork formation has been exquisite, even though we got the throw over there, really nice median line break, really nice lower parallel hold, literally to the pip. Here we are straddling the median line. What do you do? What do you do? Well, this is a 3.4 point touch support turned resistance. So if this is just a break of support, test of resistance, you should still, risk the failure, the exhaustion print, as it were, while below that slope. So listen, it's not, in my humble opinion, it's not the time to make longer term entry trades on gold at this point. I still think that there's a risk for a washout, even if we pump higher here. Again, I might be a bit capitulating, guys, but at the end of the day, you just set up a real tight weekly opening range just below former slope support, now resistance. Look for a break. So that is gold. Next up is the abomination, Gary. Here's dollar yen for you. 10. Well, we're making good time today. I'm flying through these. Here's what dollar yen looks like. And this finally looks like we're clearing the range to the upside. So again, take your top-down approach. Here's dollar yen on the weekly, yearly open resistance, 108.62. We talked about that for a while. That 107.91 level has been governing the top side of the dollar yen trade since April, since late April. Okay, we tried to test it again a couple times in May. Here's the pump. 2020 yearly opens at 108.62. Here's dollar yen on the daily chart. Former swing lows from December of last year gives you 108.42. We're testing that now. Just a little bit higher than that is that yearly open again for this year at 108.62. That's going to be a big breakout zone. And don't get faked out. And this is why dollar yen to me is important. Do you see this? Do you see how this range set up? Here's last month's open. You set a low, you set a high. We've been trading below that region for the last 5 days, 6 days, 7 days. Here's the breakout of this multi-week range should keep the focus higher, but this is still a key lateral resistance level. So it's like the first tell. So when you get these near-term breakouts that take you right into the next major resistance level, look for a reaction here. Okay, a close above 108.62 is needed to keep the long side bias. I think the long side on this immediate approach may be at risk into this region. I do like the long side. We've been looking for a pump into this, but here's the intraday. So 100% extension from the advance off the low, right, gives you 108.51. We talked about 108.40 something, which is on the daily chart there. Just higher at 786 retracement, 2020 open. Key resistance near term for dollar yen. Questions on the abomination? Multi-day range finally breaking to the upside. Mind you that the range false broke on Friday to the downside before it recovered. So classic dollar yen, mischievous price action. I'm looking for a reaction up here. All right, last button, certainly not least, Aussie dollar number 11. We got the Aussie interest rate decision on tap yesterday. No change. Obviously, the interest rate remains unchanged at 0.25%, but really we also do get some GDP growth rate data out of Australia later tonight, expected to print at 1.4% year on year. The Aussie breakout, I mean, I guess we discussed Kiwi too, but with the Aussie breakout, it's a little bit more, it's throwing me off more. And I think part of it is that the fact that I'm still kind of relying on this slope. So look, here's Aussie on the weekly chart. This slope in Aussie held way longer, right? This is from 2017, 2018. Look how many years that guided price action. When we broke below the lower parallel, it offered resistance for 3 weeks before breaking through in the 4th week. And when we broke, there was acceleration. So I'm inclined to leave this slope and then look at the parallel at the resistance level. So what is this? Is this a breakout, clear up? If it is, your focus is still on 69.53 and 70.16. But at this point, man, what do you do? Here's Aussie on the daily chart. And here's Aussie on the weekly chart, on the intraday chart. So that's my problem with Aussie, is that I just, I don't have a clear-cut formation of this particular advance. Remember, a breach of upslope resistance, just like a break of downslope support, oftentimes is the sharpest part of the rally. We've already seen a pretty decent rally to start off the day. We're about 90 pips higher. So look, it's a breakout. If this is legit and we close above here, it's a breakout. 67.74 now becomes initial support. Next upside targets, I really don't have much until the 70 handle. So again, caution, if you're long, you're just bringing up your stops at this point. If you're looking for a new position, there's nothing to do here. Would not try to fight this, although my initial inclination is to. I don't think it's justifiable here. There's no slope to warrant it. There's no. Now, let me take one step back. There's different renditions we can look at with regards to this advance. But even if you take that gradient, it still leaves room for upside. Okay, so depending on how you're looking at this, any which way you look at it, looks like a near-term breakout. Yeah, topside may be a little tired, but not worth fighting just yet. So Aussie long bias still looks like it's in play well above 67.75. Okay, and that is everything on my list. Let me know if you guys have any other questions or specific trade setups you want to review. Look, just it's worth keeping it light. There's a lot of event risk on tap. There is a lot of data releases. There's a lot of headline event risk with everything that's going on in the US. And on top of that, we're just starting off the new fresh month. So if you're not in any positions and you leave today's webinar a little bit frustrated because you're still not in any positioning, I encourage you, keep your eyes looking ahead. Markets will always provide. If you are in positioning and you're kind of wondering whether you should be fading out of these positions, my humble opinion is you take a stance of reducing exposure, bringing your stops, okay? It's not worth it, I think, in this market to bet the farm. But if these breakouts do materialize and they do hold, we are in for a little bit of a stretch, I think. So keep that in mind. Thank you. We will catch your amazing webinar next Thursday. Thank you, Eman, Kelly, Gary, Jay, everyone in the room. Best of luck trading, and I will see you on ECB Day Thursday. Cheers.